What up, nerds? My name is Luke, and today I'm going to talk to you about a model that I built to try and get an idea of value and price for Bitcoin. And it's built under the narrative and the idea that Bitcoin is going to be digital gold. So the Bitcoin as digital gold narrative has been around for as long as I can remember. It's one of the oldest narratives in Bitcoin that can attribute value to it. And it's still around to this day. When I first invested in Bitcoin around 2017, and when I first got interested in it, this was one of the prevailing ones, and really one that I latched onto. It made the most sense. Like, if you think about it, what gold is as a store of value, as a separate currency, that's something that people can save money in. Bitcoin has similar properties, and it has properties that are similar but also different enough that it can be used in conjunction with gold. Like, unlike gold, it's easy to transfer. There's no storage costs. It doesn't have an inflation rate. It has a lot of these beneficial and different properties. However, still similar hard money ideas that gold can also has. So I've built this model to try and attribute some value and some price to how much Bitcoin should be worth now and what it might be worth in the future. So the foundations of the model really rests on this idea that Bitcoin is going to ultimately be used in the same way that gold is. So it's going to be used in the same way that people save money in it, obviously not in the jewelry sense, but that people save money in it. Both personal and institutional portfolios will put a portion of their money into it as a kind of a savings, as an inflation hedge. So this kind of gives us a rough idea and the first assumption of the model that Bitcoin, if it is truly a digital gold, it should share some of the value for which gold is currently used in that regard. So currently gold has a $12 trillion market cap, and if I made the assumption that about half of that market cap value is purely its store of value, purely the store of value kind of function of gold, then I could say that, well, if Bitcoin is also going to be used in that way, then we might assume that it would take about half, right? So gold would have about $3 trillion worth of value as a store of value, and Bitcoin would have about $3 trillion. So, given that there is 21 million Bitcoins, and there'll only ever be 21 million Bitcoins, the Bitcoin price of a single Bitcoin at a $3 trillion market cap is $142,000 per Bitcoin. So this is like the current fair value of Bitcoin if it truly is digital gold. Now, of course, here's the issue. Gold has a track record of thousands of years, but Bitcoin has only been around for 10 years. So can we really value it at 142,000 if we think it's digital gold? Even if we're all sure it's going to be digital gold, can we really give it that staying power? Can we really say it has that store of value that gold has? But we don't know. Like, we don't know how long it's going to survive. We don't know if it's going to survive 5 more years, or it's going to survive 100 years, or only 20 years, right? So this is a problem. And the solution is to try and estimate an expected lifetime of Bitcoin. And I did that by using something called the Lindy effect. So this is an idea that came from... Actually, I'm not 100% sure who it came from, but I learned it from Nicholas Taleb. And I have it here quoted effectively. It says, "The Lindy effect is a theorized phenomenon by which the future life expectancy of some non-perishable things like a technology or idea is proportionate to their current age." So basically, you would say simply, if Bitcoin is around for 13 years, its expected lifetime, it's expected to be around for another 13 years. And here you can see the survival function. So it actually allows us to do a bit of math. If we say that this is the case, if we make this assumption, if we use Lindy's law, we can find out a survival function which gives us like a probability that it'll survive another X amount of years, given that it survived T in this case. So here's how the model is structured. So there are all the assumptions. We're making the assumption that Bitcoin is truly digital gold. Its fair value is 140,000, and that we can kind of estimate how long it's going to be around using this kind of Lindy's law. All right, so this is the actual model. This is our expected return given survival. So if we start with this kind of assumption, or we start with the idea that the expected return of Bitcoin is 0. That means that we have some risk that it's not going to survive next year, and therefore we have to be compensated by an expected return such that the expected value of holding Bitcoin for that year is 0. Like, we're not going to make money, we're not going to lose money. And that's effectively just the inverse of the survival function. So the returns are just the inverse of the Lindy survival function. But we also have this little piece. We have this little idea that we know what the value should be, right? If we just purely had it as the inverse of the survival function, the value of Bitcoin will keep growing infinitely, right? I mean, the returns will get smaller and smaller and get compressed, but the value would actually keep going. But we know that actually it should asymptotically approach this kind of fair value, this 142,000. So the way we do that is we have instead of just purely using the survival function, we have a modification, and that's you can see this equation here, and the minus y is the modification that basically over time, as we approach the $3 trillion market cap, we actually compress this expected returns. So with this model, you see X is basically the age of Bitcoin, and this is the yearly model, right? So this will predict the expected value. Y is a function of X. Again, as I said, over time, the actual amount of return we're expected to get gets lower and lower as we approach the fair value. So then, how do we choose Y? Like, how much of a compression should we do? And my idea was basically that if the expected lifetime of Bitcoin is around 40 years, then people can reasonably confidently put it in their pension or retirement portfolio, because you're going to work for about 40 years. You retire, let's say you start saving at 30, retire at 70, then you want to have that Bitcoin there. You want to have an expectation that it's going to be there when you retire. So basically, I chose the Y such that after 40 years, we have an expectation of 40 years, and thus the compression is almost full. It's almost reached it. And I think effectively, as you'll see in the next graph, that it's around 90% of the value after 40 years, 90% of that fair value. So that'd be 120,000 or something. Okay. That's basically, there's some technical ways of how I got that, but it doesn't really matter, as long as you understand this kind of idea. Okay, and so here is the output of the model, right? So we have here on the x-axis, we have the years since inception, so when Bitcoin was first created, all the way out into the future, and we're currently at, I don't know, when I did this analysis, I think it was like 13 and a half years. Now we're up to 14 years. Market cap is on the y-axis. This is in trillions of dollars. And as you can see, that we have this kind of curve where it kind of accelerates first and then slowly curves off, and then the actual returns you're expected to get over a year get smaller and smaller and smaller as we approach 40, and then it keeps it actually kind of really slowly asymptotically approaches the value of 140,000, or the $3 trillion market cap. You can see here in the black line, so those blue dots is the hypothetical digital gold model. So this is what the fair value should be if we were taking into account the survival rate from Lindy and our expected fair value of Bitcoin. And you can see this is the actual market cap in black. And it was way, way smaller, as you see. And only just recently did it kind of get into that range where it's kind of near the expectation. And mind you, if it stays in this range, now it's actually gone down quite a bit again from this. But if it did stay in this range, you'd have an expected yearly return, if it survives, of around 10, 15 or something like that. So obviously with a lot of volatility, but that's your kind of expected. All right, so this is, now I'm going to go into, so that was just the actual model. Now I'm just going to go over a little bit of maybe why Bitcoin itself isn't following this. And you might expect that, look, if we look back at year 0, it should have some market cap. Even in year 1, it should have quite a large, relatively large, like up in the billions market cap. And you might say, well, why didn't it? And that's purely down to the fact that the belief in a narrative wasn't there. Like, including the network size, right? People didn't believe that it could be digital gold. And thus, in order to actually have the real price follow this price, everyone involved in the network, or at least a significant number, need to believe in this digital gold narrative. And then it'll follow this kind of increasing price model. And of course, if it ever goes over it, then that's kind of like a hype. And generally that would be, if you were to trade this, a sell signal. All right, so this is just kind of covering over what I just said. And so the main thing is the real price, that's the black line, is also, it's a function of the model and the expected returns, but also a function of the belief in the narrative, right? So on the next slide, I'll include a bit of a modification to the model that includes this belief, this kind of step change in belief. And, you know, when does that occur? That might be when there's a critical mass of investors or institutions, or the network grows to a certain size or certain adoption, right? There might be a point in which there's no going back, and it's just that's what it is. It is now the gold. But of course, because of this model, it's not going to be valued at the gold because it has to survive to be proved that it should be that value. However, it will be along what you'd expect, which is 1 trillion at the moment, and in 10 years, 2 trillion. So the way I did this belief narrative is in this kind of sigmoid step change, meaning that there's a quick change from almost no one believing in it to almost everyone believing it over a short time frame. But of course, you can use other models of belief in a narrative, such as the Gartner hype cycle, which you might have heard before. That's to do with technology. So you have this first rush, this kind of explosive rush in hype and overvaluation, such as like with this AI boom or whatever else, the internet, for example, where a huge amount of investment goes, and then near the peak, people realize that actually the technology is not quite there. It was a bit overhyped. Then you have this crash, this pessimism, which goes underneath its expectation. And then slowly, as real adoption comes in, the true value, it starts approaching its true value as over time. So you could also use that model to kind of modify this. But let's have a look to see what the sigmoid step change model looks like. Okay, and so here you can see the narrative model that is almost no one believing it to everyone believing in it. And that's the kind of from 0 to 1. And then if you combine that with the digital gold model, you see, okay, look, now we have the dark blue compliant model, and it seems to fit the data just a little bit better. See, it makes a bit more sense now why the actual market cap was so much lower in the first 10 years. Because we didn't have the belief, we didn't have everyone there. And as you see, over time, we should expect that the combined model will approach the true digital gold model. And of course, as you see in this model, it's not going over it. So it's, again, a good probably trade signal if you see it way above this. If if it does get up to, if Bitcoin gets up to 100K in the short term, probably that's overvalued. Very likely that's overvalued. So we might not see that in the short term. But if we do, then it's a pretty good signal to sell. So that's the model. I'll leave it up there on screen. Like and subscribe. If you have any thoughts about this, leave a comment. If you have some models of your own about Bitcoin, if you think the digital gold narrative is bullshit, leave a comment, let me know. If you think I made some silly mistakes, or if you want the specific model with the maths and the parameters, leave a comment as well and let me know, and I can get back to you and show you how it was really derived, and maybe share with you the Excel sheet. So, thank you.